Stock market and economic summary, February-May 2025. The first quarter of 2025 was marked by significant volatility. U.S. equities started strong, with the S&P 500 and other major indices reaching record highs in January and early February, buoyed by optimism about the new U.S. administration and hopes for pro-growth policies. However, by late February and into March, sentiment shifted. Rising trade tensions, driven by the Trump administration's imposition or threat of tariffs on major partners, including Canada, Mexico, China, and the EU, sparked investor concerns about a potential trade war and economic slowdown. Inflation remained stubborn, with core prices, excluding food and energy, rising further from the Federal Reserve's 2% target. The Fed kept its policy rate steady at 4.25%, 4.50% throughout the quarter. The S&P 500 lost nearly 5% in March, and the Nasdaq declined over 10% for the quarter. Sectors like consumer discretionary and information technology saw sharp declines, while energy stocks surged more than 10% year-to-date, benefiting from geopolitical uncertainty and higher commodity prices. By late April and early May, the market rebounded sharply, especially in large-cap tech, as strong earnings from companies like Microsoft and Meta reignited risk appetite and pushed indices higher for 8 consecutive days into May. Economic growth moderated amid persistent inflation and rising unemployment, which reached 4.1% in February. The S&P 500 put-call ratio, a widely watched measure of market sentiment, has declined to its lowest levels in 5 years, signaling extreme investor optimism. As of May 8, 2025, the SPX put-call ratio stood at 1.14, down from 1.36 a year ago and well below the peaks seen during periods of market fear, such as 3.77 in 2015. The current low reading suggests that optimism driven by strong tech earnings and easing trade tensions may be overextended, raising the risk of a reversal if sentiment shifts. Key takeaways. The last 3 months saw a dramatic swing from optimism and record highs to a sharp correction, followed by a tech-led rebound in late April and early May. Economic risks remain. Inflation is persistent, unemployment is edging higher, and trade policy uncertainty lingers.